now what I'm going to do is I'm going to take you to the Twitter page for which we posted a number of interesting comments this week, especially considering how active it's been. And all of you can actually join this Twitter page. It's called Naked Swan Trader, and there's a link in our website, which is nakedswantrading.com. Right at the center of the website, you could click on that, and you could actually start following our updates. There were numerous ones this week. As you could see, there were several placed between the 8th and the 9th. And a couple of the very interesting ones we're going to speak about today is the comment that we made regarding not to be fooled by the intraday rally, which was posted on April 9th. And we said that there would be a strong reversal imminently, and the market did reverse within just the next couple days. Once again, there was also another tweet that was put out regarding that overhead resistance for the S&P 500. It was in the area of 1387.75 to 1397.25, and that was posted on April 9th. And you can see very clearly, even the rally that we got today was within the normal range of what would be expected in bear market rallies in the down move in the market. When I use the term bear market, I'm using it rather liberally. I'm not referring to the fact that there has to be a 20% correction. It's just referring to the fact that there was a short-term thrust down that's likely, as I indicated over the past few weeks, will continue through the April period and well into May. And at that time, we will then evaluate which areas and sectors seem relatively strong so we could go along those sectors. And that's basically the idea. But right now, the focus should be on really trying to find shorting opportunities as we get this rally into key resistance. And when I plot out certain ranges that are interesting to consider exiting the market or to really think about shorting opportunities, for example, the 1387.75 to 1397.25, what it means is that that becomes the risk window where interesting events and fundamental news will really amplify opportunities in the market on the downside. So once we get inside that box, and we got pretty close to that box after hours today on the S&P 500 as we push towards the 1390 area, at that point what we're going to be doing is we're going to hone in to the shorter time frames and identify trading opportunities that confirm that this structural resistance area is actually a new sell signal that will allow us to trade the trend and continue the move down towards the next area of support on the S&P, which, as I indicated last week, if we were to break the critical 1380 and especially 1370 area, we would start thrusting towards the 1350 and then the 1340 and 1330 area. 1320 would be an outside spike, and even the long-term or intermediate-term resistance, intermediate-term support, pushing into the later part of the month or May is at worst 1295 to 1275, but one step at a time. So the next step down, we're going to be eyeing the breakdown of 1350 towards the 1330 to 1340. Now that's a nice trading opportunity if we could enter the market closer to 1390, especially given that each point in the S&P is leveraged when you're trading the futures market. I'd also like to point out, and now we're going to kind of leave the Twitter page after just one more comment here. I also put a posting out saying that a stock by the symbol FFIV was going to roll over very strongly with downside tail risk, meaning exceptionally strong reversal off of a high level or high valuation. That was posted on April the 8th on Twitter, okay? And basically, imminently thereafter, as you will see as I go through the charts, the stock FFIV, which is actually F5 Networks, a networking company, rolled over very strongly and very imminently after the call. Those are the kind of opportunities that we like tracking, and there are numerous other ones, as you could see as I scroll through this list, that actually identify different sectors, different stocks, different levels, and different ETFs that are going to be under high energy pressure as we pull through this correction. So now just going back to Apple, right now we're on a 34-minute chart. That means each bar that we're tracking, which is the rectangle, that has a high and a low price for every 34-minute interval. And basically what you can see in the screen right now is the interval between April the 9th and today, April the 12th. And you could see, as we indicated in a number of calls that last week, that any rallies on Apple should not be investment opportunities, even though there may be fundamental traders that are suggesting Apple's going to 1,001 a share. You know, in the long term, sure, why not? But it's the short term that could really hurt you. And we want to be there to actually give you some insight into how you could take advantage of volatility in your favor. And obviously there's two ways of doing that. One is to actually express that as a short trade, or two, you know, for the investor to actually take profit or just exit the position and find other opportunities when the dust settles. And as I indicated, that's unlikely to settle until at least the later part of May. Now, an interesting phenomenon that happened in Apple today especially was the unprecedented weakness relative to the way it has been behaving over the past number of months, especially considering that the Dow Jones Industrial Average was up 181.19 points today. And, you know, for such a rally in the Dow, and especially considering that Apple Computer is a component of the Dow Index, to have such a big rally and have Apple go down $4.65 into after-hours trading today is quite a testament to the weakness in Apple. And it also is a testament to the fact that the trading parameters that we are looking at here at Naked Swan Trading is allowing us to take advantage of. And what is really precarious about where Apple is placed right now in the price and time configuration is that it is resting on a boundary that has absolutely no support until the next lower leg down, which is right around the 599 level. Now, that's not, you know, the end of the world, but for a short-term trader that's trading Apple for trying to, you know, scalp 20-point moves, being on the wrong side of the trade and being leveraged could really be harmful. And secondly, given that Apple is capped up at that, you know, up at this high, and all these boundaries in the future, as I indicated last week, really don't go much higher. I mean, yeah, there's one maybe that goes out, you know, if you extend, you know, into, you know, well into May, but we're not in May right now, and there's a lot of time before May for damage to happen, considering that there's a lot of markets and equities that are breaking down. And, you know, even in May, it's 660 is about the most extreme point there is, and considering that the recent high here got up to 644, and it failed to, you know, to hold on any consistent basis above that extreme area, which was a risky long-term resistance area at 638, the market showed weakness and started to roll over. We put a comment out on Twitter just slightly after it rolled over below the 640 area that this weakness was going to actually turn into a precipitous drop as soon as Apple was to break the 633 area. And why did we make that comment? Well, to keep things simple and without going into the background of necessarily why the model framework works, that will be for maybe a different webinar, as it would take probably a couple hours to really go into detail. Today, what I'm going to just show you is that concern in the market takes place when we have more than one time horizon having a confluence of upper boundaries tracking along each other and then price getting underneath it. And you can see over here we have the white boundary, which represents traders from a specific time frame, and then we had the purple boundary, which is traders from even a higher time frame that were basically tracking each other. What does tracking each other mean? It means that when they get market information and they try to make sense of where the trends are going, both of those time horizons are going to be seeing the same type of risk and reward and momentum kind of objective. And when you actually get a trend reversal below these boundaries, and what makes it important that it's these boundaries and not some other boundary? Well, what makes it important that it's this boundary is that there was a trend that originally broke out from these boundaries. So you always have to reverse the trend from where it broke out from. And what you will see is that when we got below 633, we made a comment on Twitter that the price action was going to come down very sharply to the 620 area and possibly spike down to the 615. Today we pretty much got into that area. We got down to 620.50. So that's about as close as you're going to want to make a call there. And what's really interesting about it is that now we're resting on another boundary condition which has the same kind of parameters. Over here we were looking at the white boundary and the purple boundary tracking each other, and now price came down to the navy boundary and the yellow boundary, which is tracking each other, which basically means that if price now gets underneath the 620 area, and let's say we close underneath 616, which is in the cards. It's not a matter of whether we're going to, but when we do, then you're going to see real acceleration. The acceleration that you saw in this bar is going to really pale in comparison to the kind of acceleration you're going to see as we move between this purple boundary and this teal boundary. Now, the reason why this move was rather large is because there was a large gap between this blue boundary and the lower boundary. But again, the magnitude and order of this down phase is quite substantially larger, and therefore the expansion and volatility that's going to take place. How do we know that these two boundaries are the relevant boundary? Because I don't want to make it look as if I'm just pulling it out of a hat. So what we do is we try to go back in time to the last major breakout in the market, okay? A breakout in the market for which price broke out with high volume, and we could see here there was a gap in the market of very high volume, and we want to see a situation where it breaks out of a boundary that is both sloped sideways and on top of each other. And you can see the biggest boundaries that are sloped sideways and on top of each other is the green boundary and the yellow boundary, which basically means that any boundary condition larger than the yellow boundary that has a situation in the future where it is tracking a larger boundary is going to actually give us insight into whether we're going to go down to the bottom of that boundary. So we're really saying that we've got tail risk, meaning maximum potential downside in Apple in the near term to 520. But the nature of how markets work is they don't necessarily have to go down there all at once. They do it in a stair-step fashion. Now, obviously, if some fundamental news driver was to come into the market and rattle Apple, then we could come down there within a few days, like by the 19th, easy. Now, I would have to say that if we get down to that level and it's still April, then anybody that is short Apple should really be considering taking profit. Not because it can't go lower, just because that is where the tail risk exists, and that is where a balance point exists. And if a new signal forms at that level on a smaller time horizon and indicates that we're going to go down to the next lower level, which would be 472, and if again it indicates that we're going to go to the next lower level, which would be 375, which is long-term support, then likely that is where a long-term investor may be really interested in buying. All these other boundaries along the way, if a buy signal does form off of this boundary or this boundary, then that is basically very nice trading opportunities that could take you back to 660 or 680 in Apple. But considering that the recent high, and for traders that may have been holding Apple on the recent high being at 644, a move from 644 to 680 is not really worth it, considering the fact that as soon as you get back up to 680, the market's likely to come back down. Now, it doesn't matter whether it goes lower than the balance point of 500 or 375. The key thing is you're sitting with dead money for an extended period. And the goal at Naked Swan Trading is to try to find opportunities that are active immediately in the future, so that we could actually, so that we don't have capital that's sitting and just waiting for something to happen. Eventually things happen, but that's just not an efficient way of trading. So that is our view of Apple, okay, in the near term. I'd now like to take you to the chart of the equity that I referenced on Twitter that we made an announcement on February the 8th. And on February the 8th, we said that the stock F5 Networks was in a precarious state and was going to roll over imminently. And it did, pretty much immediately. And if we go back, let's go back to February the 8th. February the 8th, well, that was the day before it actually, that was actually the day before the market opened. So let me just check this out over here. So February the 8th, it was basically Sunday. So Sunday evening, before even the markets open on Monday, I was aware that there was going to be a serious reversal. And you can see imminently the market, I'm going to zoom in over here so you could see it very clearly. And what you can see here is that F5 Networks made a high on April the 3rd at 139.46. It made a high with 1.383 million shares. Now, if you compare that high with the previous high of 1.191 million shares and also the upthrust bar of 2.2 million shares, you would be in an ambiguous state of comparing volume. Where would you be comparing volume? Would you be comparing volume of 1.3 million to the bar of 1.1 and saying that it was a legitimate breakout? Or would you be comparing the volume to the most recent upthrust prior to the point where the dust settled and the market reversed? That is an ambiguous question for traders, and it's not one that I really care to answer just from the point of view that I don't actually believe, based on the analytics that I follow, that just looking at volume alone is going to give you insight into whether to fade a market at an extreme. You could have situations where you break out on very high volume, but it actually represents a capitulation. The fact that everybody that wanted into the market thrust it into the market, and now the market is set for a pullback. Now, that doesn't mean eventually this high volume bar is going to act as some kind of support and allow the market to go back up. But the problem with that is that our downside objective was expected to blow through this bar. And if we try to analyze what the biggest volume bar was as we descended, you can see this bar over here came down with 1.7 million shares. So we have still yet to take out the volume of this bar, but we gapped underneath that bar with 3.6 million shares. So even according to any technical analysis methodology that uses volume as a key indicator, even those indicators at this point would tell you that this down move has blown out all of the up volume in this trend that developed between March the 13th and this recent high on April the 3rd. And that basically means that that uptrend is over and you are in a down phase. Now, volume isn't going to tell you how low you're going to go. So you need some methodology that's going to be able to tie together all these moving parts. And that is what we try to do here at Naked Swan Trading by actually looking at these boundary conditions that represent balance points of zero momentum for different traders on different time horizons. Now, just to go back a bit into the theory and why that works, so you could build some confidence into the logic behind the methodology, is that it's just like, imagine if you were to throw a ball up in the air. The ball is now moving rapidly into the air, but because there's gravitational force, eventually what's going to happen is the ball at some point is going to slow down, and precisely just before it falls down to the ground, its momentum is going to go to zero. Okay? And when that happens, there's a key change. Same thing in the market. Our goal in the market is to find some sort of sensing instrument that's able to identify when the ball, in this case price of an equity or future contract or any financial instrument, is going to switch from positive momentum to zero. Because once it's at the 0 point, we know that as soon as it gets underneath it, no matter how small the stimulus, whether it's just a random variable and a trader just deciding to sell on a stop order, or whether it's a fundamental news event that causes some traders to actually sell the market, that could be enough to tip it. And if you know that the distance between one 0 level and another 0 level is large, it gives you insight into how long it's going to take to unwind a trade that has been concentrated by a lot of traders in different time horizons. And by the very fact that when price rallied up to this high in March and April, it rallied above so many different boundaries from different time horizons, which basically meant that it was very expensive and definitely far above the ground, which basically means that there's a long way for it to drop. And what we saw on April the 8th was a situation where price broke out over here, for example. Let's just go back to where the breakout occurred. It occurred on March the 13th. And as I said before, we're looking for boundaries, the biggest boundaries that are sideways and on top of each other. And the biggest boundaries that were sideways and on top of each other was the pink boundary and this blue boundary. You can see over here, if I zoom in, there's the pink boundary, there's the blue boundary. The red boundary was the next higher one, but it was not zonal. It wasn't going horizontal. So it's not part of the box that broke out. So what do? We wait for price. We wait for a situation, okay, where we actually have the blue boundary underneath the red boundary. And we had the situation where the blue boundary got underneath the red boundary. It started tracking it, and we got on the other side of it. Not only that, we also had a situation where the white boundary, and we knew, don't forget, we know about these boundaries well in advance, because today we could already see the white boundary over here, which basically means that when I was when I put out the announcement on over here on this bar, we already knew what this white boundary was looking like. We already knew what this purple boundary was looking like. So which basically means we already knew that this white boundary was tracking the purple boundary, okay? And the very fact that the white boundary, which represents a shorter time frame, is underneath the longer time frame, what does it mean fundamentally? It means that when information comes into the market and price changes, it means that traders from higher time frames are going to have first insight into the change in trend, which is exactly opposite and counterintuitive to how traders' mentality is. People normally think that, oh, it's the short-term trader, that if they analyze data at a faster frequency, they're going to get their insight faster than the longer-term trader. But what happens at these critical turning points and in what we call risk windows at nakedswantrading.com, that what happens is that when a breakout occurs and short-term traders start chasing it, and when they chase it, they're chasing it with a smaller number of shares, because shorter-term traders trade fewer shares than longer-term traders, just because you're actually able to put on a larger position if you're holding it for a longer period of time, just due to the nature of trading. And because of that, what happens is the short-term trader gets sidetracked when one of the big whales and institutional traders start selling. And then you start getting a cascading effect where short-term traders start selling on top of the longer-term traders, and you end up getting an acceleration in the trend. And that's exactly what happened when price got underneath this blue and red boundary, and especially when price got underneath this white and purple boundary. And you can see there was a big gap down to the white boundary, and now there's a huge gap down to the purple boundary. So all these boundaries are pointing down now. These boundaries are sloped up. So the next, major level where I believe, profit should be taken, or at least, look for a short-term reversal. And I'm not saying a long-term buying opportunity, and I'll explain why, but definitely a potential trade or an exit would be around the 98, 91 area. But considering that we made the call when the price closed at 135.93, within 2 days, the price already dropped down to 120, which is a pretty significant move. And if you were to analyze it on a very short-term time horizon, you could have taken some profit there, or even today. And then if it takes out this low, you could then re-enter. Because in the meantime, the market is bounded by this zonal action over here. So if the market decided to rally into here, what's going to likely happen is if you go down to a smaller time horizon, you're going to end up seeing sell signals develop along this boundary. But considering that we're already in a sell signal, there doesn't even have to be a rally. So technically, an intermediate term trader that's trying to trade the short-term trend into the April and May period could technically, look to add to a position when we get a new sell signal in this area, or just, stay with the position until it actually gets down to its objective and take some profit, so that once you're, in deep profit, you don't want to start, taking a loss and not keeping your profit. That's one of the keys to trading. Now, just to go back to why I don't believe this is a good long-term opportunity to buy the dips, let alone the fact that the trade that is currently in play, where there's extreme force, plays out into the mid-May period, because we have this white boundary tracking this purple boundary. And why was the white boundary and purple boundary relevant? Well, it's because if I go over here, I said we always look back to the action where the market recently broke out, and you can see that the market recently broke out back in the October period when the market reversed, and it broke out of a situation where we had the red boundary, and just at this time, the white boundary, horizontal. So basically, any boundary condition larger than the red boundary that was sloped and tracking a longer-term boundary, and in this case, the first incidence where that happened was with this white boundary tracking this purple boundary, and we got on the other side of it, it automatically meant that we were in trouble, okay? And even going further out, you could see there's another situation that's precarious, is that as you go further towards the end of the year, we have a situation where the black boundary is sloped up, tracking the red boundary, and basically when you get into this period, it's basically saying you've got downside risk to, to at least $70. And, in a really bad market, you could come all the way down to this red boundary. And, given that there's going to be some kind of interim low sometime in the spring or summer next year, $20 is the tail risk on this stock. Does that mean the stock is going from $134 where it was a few days ago down to 20? No, tail risk basically means that if you're a long-term investor and you just want to let your portfolio sit, you must be aware of how risky that asset is. And that is how risky it could get when events, get pretty ugly, as we, progress after the December period in the overall equity markets. And in that scenario, whether that scenario plays out or not, I could find other equities that don't have that kind of risk. So why would you want to be in an equity that could actually get decimated when, I would rather just wait for the dust to settle. Let this initial signal settle down. Let's imagine it settles down at our objective around like the 99 area, and then basically it forms, let's say, a buy signal, and then, not necessarily, if a person wants to trade it, sure, but I'd rather just find a long-term buy signal on a stock that I could be comfortable with that has no tail risk, and then find a buy signal on a short-term time frame around the same time this has a buy signal, and participate and make the same amount of profit, but have less tail risk. That's what I call smarter trading. So you don't have to be just focused on one security. You should be opening up your world to a large number of securities, okay, so that you could find good risk-reward opportunities. So that pretty much covers F5 networks. Now what I'd like to do is just close up with a discussion on the NASDAQ, because actually probably the S&P, because that's like the key market. So I'm going to take you to the S&P, and I'm going to take you to the 89-minute chart. So each bar represents 89 minutes, each one of these bars. And what you can see over here, don't worry about all these lines. I'm actually going to remove it just because it's acting as a distraction. Okay, so I just removed it, cleared up the screen, and I am going to now zoom out so we can see a little bit more of this. Okay. So here's what we see on the S&P. If we scroll back here on the S&P, we recently, you know, if we go all the way back, let's say to this breakout that occurred around March 13th, and we try to see which boundaries were zonal going flat, you could see it was the yellow boundary and the navy boundary. That those were the two largest ones for which this breakout took place. The next larger boundary was sloped up, so it wasn't flat. So therefore, the relevant boundary that will then tell us when the move is going to be over is going to be a situation where we have the yellow boundary getting underneath the navy boundary, or any higher term boundary getting underneath a longer term boundary that's tracking each other. So let's fast forward into the present time and see the first situation where we actually had the yellow boundary track underneath the blue boundary. And you could see here, we saw it dipped underneath the blue boundary and started tracking it zonally. That is the key that tells us that there's going to be a reversal in the market. And it is the key that tells us that the ball that's being thrown up in the air, which is like the price above a zero balance point, is actually going to switch from being positive momentum to zero and then heading south. And as I indicated, each one of these lines represent zero. So as soon as you get underneath it, it reverses. The key thing is these boundaries are always being crossed, so in order to identify when there's going to be a trend reversal, you have to calibrate it to where the trend originally broke out. And that's what we just did by going back to the horizontal box where the yellow and the navy boundary were horizontal. There was a breakout, and then we're just waiting for the first situation where the yellow boundary is underneath it and tracking each other. And that's all there is to identifying a risk window. And the risk window is in play for maximum thrust while that boundary is zonal. You can see once that boundary is crossed, it's passed, and now we get a reflex rally. But that just represents the first thrust down. That does not tell you when the move is going to end. The move does not end until you have to look at the lower boundaries. And we still have lower boundaries that are still sloped up. And we still need to get a buy signal. And it's the same thing. We just do the opposite. We look at where the market recently broke down, and we try to find the biggest boundary that was zonal to each other. And if I zoom in over here, you can see the biggest boundary that was tracking each other as it broke down was the purple boundary and the teal boundary. This other boundary was not on top of each other. So therefore, I'm looking for the first sign where this purple boundary rises above the teal boundary or some higher boundary. The teal boundary rises above here, and then price breaks out of that. But you can see here, this boundary here is not yet crossed, and it can't cross. It's not even possible to cross unless we get a sideways move and a lower low. And so there's likely going to be one more low at minimum in order to actually get a short-term trading opportunity. But this short-term trading opportunity is not a buy signal. Why? Because I indicated that any long-term boundaries bigger than the yellow boundary tracking the next higher time frame is actually a risk window. And you can see here, as we progress through April, we have a situation where the navy boundary curled underneath the black boundary and is now tracking it going all the way into April the 24th, which basically means that we're under overhead resistance and strong downside risk going into that period. So what insight do we get out of this map in order to tell us or to give us clues as to how high this market could go before it reverses down, and how long or under what scenarios would have to play out for the next move down to actually trigger and get another short-term sell signal to confirm that this trend is going to continue down? Well, you want to have a situation, as we said, you don't get a downtrend or an uptrend without breaking out of a box that is zonal to each other. And if price is over here, so let's zoom in over here. We're now sitting over here at the close. And I'm now looking below us to try to find boundaries that are zonal. I don't see any. There's absolutely no boundary. This boundary is not horizontal. You can see this white boundary is now starting to go horizontal with this purple boundary. But until price moves into the region where that is the case, there's not going to be a fresh new low. We could have short-term sell signals that take us down and push us down to 1350, at any time, and I'll go into that. I'll take you down to an 8-minute chart and show you precisely when that could happen. But in terms of actually blowing through this critical support, this new critical support, which is 1350 on the S&P, it's not really relevant, because what would end up happening is you would blow through it and then price would flip around the other side. To get a persistent break below that point and a legitimate breakdown, you would literally, it's just a time thing. Time has to go by. And what makes time go by without price going higher is the fact that there's a lot of resistance in this area. So if price decided to rally, and you can see these boundaries are sloped up, any boundaries that are sloped up act as resistance. So that 1394 to the 1397.75 is the first line of resistance. If there was an exceptionally strong news report and something crazy happened to the market and people just went ballistic, yeah, I mean, you could get a one-bar wonder on an intraday bounce to 1415 again. But you're still in the bear trend, because that high is not being taken out, nor will it be taken out, because we are in this risk window where this boundary is tracking each other, and the odds that the down move is going to continue is extremely high. And I've been looking at these things for over 16 years, tracking back equities and commodities, hundreds of years back even. And in those situations, there were numerous times where, very, very few times, where a situation like this happened, and you were actually able to make any kind of higher high, let alone a higher high that would actually be sustainable. Just don't see that, at least until we get that correction that ends into the end of May, or at least the later part of May. Now, what I see happening is that because we have so much overhead resistance in here, which we didn't when we were down here, right? There were some boundaries that were sloped down up till here, but then everything starts sloping up again. So the speed of this upthrust is coming to is going to wane and come to some kind of stall in the next few days, if not sometime tomorrow afternoon, and possibly as late as, say, Tuesday afternoon. And when you get on the other side of this boundary, let's say 1380, we're likely going to have a sell signal. And because this is acting as, because these boundary conditions are slowing down the speed that the ball or the market is going up, we're getting closer to that point in time in the short term where the ball is going to have zero momentum, or price is going to have zero momentum. And when that happens, gravitational pull of longer-term traders will start pulling it back down. Now, what's going to end up happening as you start slowing down is that these boundaries over here, the way they work is that they start flattening out when price action starts slowing down. And you can see here, there was fast price action, and they sharply sloped down, which is bullish. But because these are only, this huge up move was only able to get a few time horizons to turn bullish short term. You could see the longer term horizons were not impacted. If they were impacted, they would have sloped down. But instead, all that's happening is that this upward and short term move is causing them to actually go horizontal. And once you get a number of these boundaries going horizontal, and the first instance I see that's rather significant is the afternoon of the 17th, and then if you progress into the 20th, and it still gives us plenty of time to play out that risk window, that next nearby risk window into April 25th, which basically means that once that's zonal, and we now have confirmation on a shorter term time horizon, let's say like an 8-minute chart or 7-minute chart, or anything smaller than the 89-minute, that says that the price is starting to move back down from that zero balance point, then it tells us that not only do we have the short-term traders starting to sell, but we also have the orientation of the way traders on longer-term time horizons are going to see negativity in the market, such that when price breaks below that horizontal box that's going to form in this period, you're going to get a dramatic downside acceleration in the market that's going to take you down to the next major level. And that next major level is this black boundary. You can see we progress from one boundary to another. And the only reason why volatility increases when you move from one boundary to another, or decrease, is dependent on the distance between those boundary conditions. You can see here there was a larger distance between the yellow boundary and this blue boundary than there was between any boundary that existed from the high. So the market did reverse, but it took a number of days, and then you can see acceleration. Well, the same thing's going to happen here. Once we reverse, we've got the larger acceleration from this blue boundary down to this black boundary, and that black boundary is at 1334, which is in that area of 1330 to 1340. That is what I see. Now, if I take you down to the shorter time frame, that will give you insight precisely, high definition insight into when this reversal could take place. Let's go to the 7-minute chart on the E-mini. Here's what you will see. Okay? This is just each bar represents 7 minutes. Now, let's go to the most recent breakout that occurred. We want to determine. The idea is to determine when this breakout is going to end. Okay? Now, what we do is we do the same analysis. We go over here and try to identify a breakout. We had a breakout, short-term breakout, and we're trying to find the biggest boundary condition that was zonal, which basically means horizontal on the upper volatility band. And you could see here that the purple boundary and the white boundary started going zonal. The next higher boundary was not zonal, so therefore the relevant boundary that we're looking for a reversal is going to be the purple boundary sloping underneath the teal boundary. And you could see we have yet to have that. But after hours today, what just happened, because we rallied into that first line of resistance, which is at 1387 area, as I said, to the upper level, which is 1397, the fact that we got to the first level, what it causes is the market to start decelerating its speed up, which took place this afternoon. And that deceleration, what it's causing is it's causing this purple boundary to start crossing underneath this teal boundary. Okay, and as I said, because this is the boundary that's calibrated to where the breakout took place, any rallies that take place at this point is going to cause this purple boundary to start tracking this teal boundary. So it's rather deceptive, because what it's really telling us is that up moves in an overall downtrend will actually trick traders, because traders that follow momentum strategies will be led to believe that momentum's increasing, and they keep on getting reinforced by positive trades. But what ends up happening is that the last thrust up, those traders don't realize that the calibration of the boundary that we're trying to track based on where we broke out is coming to a close. And that is when concentrated bets by short-term traders start failing, and they start giving back all the gains. So the whole idea of naked swan trading is to try to identify areas where short-term traders that have high-impact trading strategies could then utilize this insight in order to supercharge their existing trading strategies. So we're not trying to change people's beliefs of the market. We're just trying to enhance what they already know. Or for new traders that don't have a system, could then utilize this insight in order to gauge market strength and make better decisions. And by having better decisions, you could then, discuss that with your individual investment advisor, and then maybe, get some, better insight into what may happen in the market, as opposed to just listening to everything somebody says. Okay, so this is very objective. So basically, we are going to know that this market is going to reverse when this purple boundary gets underneath here and starts tracking it, and then on the next any rally, and then price turns on the other side of this boundary, then it's telling us that we're going to come back down to the bottom of the teal boundary. But this teal boundary rises. So if this takes a while to happen, let's say a while being like, the next, 12 hours, then this teal boundary is likely going to rise into this black boundary. And really, you're going to have support at the 1378 level, which basically means that at best, this high boundary could give you a sell at 1390, and you could have a 12-point move to the downside. But that's not the ultimate reversal. To get the ultimate reversal, you're going to need all these boundary conditions to start sloping up, because sloped up boundaries reverse the market. And as I said, you need to have a zonal breakout. And we have our first zonal breakout in this area somewhere from the midday of the 13th into the 15th. Okay, so Sunday evening. So if for whatever reason we get this condition in the sell signal, and it happens to line up while we're over here and price comes down over here, that would be the first area to take profit. If price actually breaks underneath this area, which is the critical support area of around, in the longer term time frame, it's 1350.50. On this time frame, it's around 1354.20. If you get underneath that while this is zonal, then yes, you're going to thrust down to that next area, which could go into that 1330 area in the S&P. There's also one other bit of insight that I would like to provide, traders with, and it's really not related to, why I think the market or why this analytics methodology thinks the market is going to reverse course in the near term, but it's actually related to why trading strategies fail, and that is mainly because humans and traders are emotional creatures. And what happens is that you may have a great trading strategy, and it may work in a certain time zone, and then traders will start changing or tampering with their parameters in order to fit the next period. And part of the problem is that there was really, most of the time, there's probably nothing wrong with the trading strategy. What's wrong is that without knowing what market state you're currently in, and what I mean by market state is that is the underlying short-term and intermediate-term and long-term trend in your favor. Because it's only when institutional capital and short-term traders are aligned that trading strategies that are back-tested, that have demonstrated profitability, are likely going to continue performing. But if you get into a zone where they're not aligned, it doesn't matter what trading strategy you have, you're going to get into a very choppy trade, and changing a strategy at that point is probably the very wrong thing to do. What you need is you need some kind of meta strategy that gives you insight into when it's safe to trade on the short side or safe to trade on the long side. And that is one of the major goals at NakedSwanTrading.com. Another thing to keep in mind that is important to understand when you're trying to identify when a prolonged uptrend or downtrend is likely to turn course. Because a lot of times what happens is traders think that the move has exhausted itself, whether it's on the upside or downside, and they end up looking at key pivot points as structural areas to actually get into a trade based on a breakdown or a breakout. And what happens is a lot of the times when a trade is firmly has been firmly intact for an extended period of time, what tends to happen is that when there's a fast acceleration up, traders that are deep in profit and want to protect their profit express their risk management not in the equity market but in the options market, and especially institutional traders that really control these markets. And when they express their risk management in the options market, when technical levels break that short-term traders think are important, what ends up happening they get stopped out of their trade and then the trend continues higher. That happens in the mid stage of a trend if you don't know when the boundary conditions that we're kind of looking at tell us when the trend actually ends. Because a trend that ends has to be tied to where it begins. It can't just be an open system. Okay, you have to define it as a closed system in order to actually tell you where the beginning and where the end is. Otherwise, you're going to be, following, numerous trading strategies that will create great ambiguity. And one of the strategies that exists today that creates that kind of ambiguity is Elliott wave theory. I don't want to go into it, but the problem with it is that there is many ways to analyze trend formation, and depending on what trader is and what time frame that trader is looking at, they're going to get a different insight. And they get different insights because they don't know where the beginning and where the end of the relative trend is, because there's more than one way to identify the beginning and the end. And in this trading strategy, there's only one way to define the beginning and the end, and that is by tracking where 0 points in price break out and when those 0 points are about to fall from positive to crossing 0 and then heading down on a big gap. And when there's a big gap, there's a big opportunity. So not all the time does volatility have to be a bad thing. There's good and bad volatility. Okay, and we're all about finding that good volatility. So going back to what I was just explaining a few minutes ago regarding traders that get tricked into a market by thinking that these stop levels are going to actually reverse the trend, only to find out that institutional capital comes in and starts buying again. And that basically happens because those institutional traders don't really care about those technical levels at that point in the cycle. That's the key. At that point in the cycle, they do care about those levels, but only at the critical points. And in my analysis, what I found is that if you look at the option market and you look at the equity market and where institutional and large block trades come in, what you will see is that their risk management objective gets expressed in the equity market almost all the time when you enter the risk window. If you're outside the risk window, it gets entered only a little bit in the equity market and mostly in the options market. And because of that, the average retail investor that is not really focused on looking at the option market to gain insight is not going to know when and how to place their stops around a broad trend. So one of the keys here at NakedSwanTrading.com is to try to let you know where institutional capital is going to express their risk management objective, because when they express their risk management in the actual equity market that you're tracking, or the futures market that you're tracking, as opposed to the option market on the futures market or the option market on the equity that you're tracking, then that is going to tell you when key breakout points that reverse a trend are going to work. And when that happens, any trading strategy is going to be catapulted to a higher level of performance. So that pretty much closes up the trading, forward-looking trading objectives for the next week. And just to summarize that, I am seeing a continuation of the short-term trend with the 1330 to 1340 area being the next objective to the downside. Apple Computer to be one of the weak laggards going into the April and May period, and F5 networks to also follow suit on the downside. So that pretty much closes up the webinar for this week at NakedSwanTrading.com. And just to know that next week is going to be a very active week, I encourage all the listeners to focus on going on to NakedSwanTrading.com and click on Naked Swan Trader, the Twitter logo that you'll see in the middle of the page, or you could just go on Google, just Google Naked Swan Trader Twitter or my name, and you will see a link to that site, and you basically click follow, and you will be able to get real-time updates as I come up with these ideas based on the analytics that we call bottom-down analysis. So anyways, until next week, thank you all for listening.